branch of SAIC of ICI to this bill to practice the new Income Tax Act 2025 Series 2 Profit and Gain from Business and Profession. To develop upon this subject, we have with us CS Sumeet Khurana sir. Now I request our eminent speaker, our income tax expert, CA Deepak Chopra sir, to kindly escort the session speaker, Sumeet Khurana sir, onto dais and welcome him with the knowledge book. Thank you, Deepak sir. Members, it's a privilege for me to introduce today's esteemed speaker, CS Sumeet Khurana sir. CS Sumeet Khurana has more than 2 decades of experience in tax matters, focusing largely on litigation. He appears before appellate commissioner and tribunal like ITAT, SESTAT, VAT tribunals, etc. to defend his clients. Sumeet is a passionate writer and his article find place on portal like Tax Sutra and TaxMat. He often shares his view on legislative and judicial development as a speaker on different forums. As a student of taxation, he is always eager to learn from professional colleagues, and that's what brings in more here today. With this brief introduction, I present before you CS Sumeet Khurana sir for today's session. Sir, welcome you. Over to you, sir.
Every change comes with a little of difficulty and pain. But this change, I hope it will not be, because there's hardly any change. So what really we will do today probably is, see, change is not always what, in terms of text of the law. There is a change, a very big change. It is not 1961 Act, it won't be there. So what is there with that? So there is a perceptual problem, perceptual difference. It's a new legislation now. Earlier we had explanations, provisos, now we have subsections. Same language, nonetheless a different style of writing. We have tables. But does it really make a difference? Should it make a difference or will it make a difference? Does it make a difference? Should it make a difference? Will it make a difference? 3 different statements. What do you think?
It will make a difference.
Huh?
It will make a difference.
It will make a difference. It should not make a difference, but it will make a difference. How? Because when the same section now you will read again, because ideally any new as a new entrant in the profession, he will apply fresh mind to this. An officer may want to think differently. He will say, okay, what is there in the past, we will see that. But let me read it afresh now. So there will be a fresh look at the very same provision maybe, and different things might be. So that's the whole objective of having this deliberation that I see. It is not necessary, because if you say, Taliya will deliberate on the changes, we can finish changes in maybe 10 minutes and go home. That's not going to be helpful, because ultimately what we need to really kind of absorb and be up to date is what is there in the subject as a whole, and not necessarily what is the tapering here and there. So with that perspective, I'm going to start my session, and please, one very big caveat, whatever I'm going to say here, even though it is recorded and all, that's a different thing. It is not an advice. It's not an advice. It's a deliberation and sharing of analysis thoughts. So with that note, I just start my today's deliberation. So the starting which I am taking first thing is the presumptive taxation, predominantly section 44 AD ADA. When we are all conversant with that, there are issues which keep coming, keep haunting us. There are other sections also like 44B, BB, BBB, etc., which are very less used in practice. But certain fundamental principles, they cut across all these provisions. So essentially, the presumptive basis of taxation, when we see, instead of computing your income under the regular course of computation, making routine allowances as per different sections, one set of sections will say forget everything, take your gross receipts, apply this profit rate, that's your income. While the objective of this is predominantly to introduce simplicity. Objective of presumptive taxation is to have simplicity. But is this simplicity possible when people, I'm sorry, like litigators like us, myself my brother from litigation only, so we are kind of a breed which will keep complicating the simple things. So I take that burden on my shoulders, a responsibility of being a part of the whole process. So we quick look at what the section says, and then we dive into what are the complications which have surfaced so far. So 44AD, I mean, as you know that it applies to any business other than the business of hiring and leasing trucks and all, goods carriage. It applies to a case where turnover is less than 2 crores in a case, normal case, and 3 crores when your 95% plus receipts are not through cash but through banking channel, and you are not earning income in the nature of brokerage or commission, you are not carrying agency business, and you are not claiming deduction which is meant for SZ. And in that case, 6% of your gross receipts will be your business income, and 8% in case of your amount received through cash channel. Nothing as simple as that. So what has literally changed in this CPC is what is commission, what is brokerage was earlier undefined. Nobody had literally a problem in understanding these words. Now it is linked to what we knew as section 194H definition. So the commission income and brokerage income definition now is linked to that. So it is no longer an undefined. It is at the limited stage. 44ADA, another similar provision which applies to professionals basically earning less than 50 lakhs of gross receipts, which can go up to 75 lakhs if you don't have too much of cash element, as we saw, not more than 5% cash element, and 50% of the gross receipts is deemed to be income from business without getting into detailed disallowances, etc. Now, what kind of issues we have seen in this? For example, there is this relatively recent judgment of Honorable Bangalore Tribunal in a case where the SSC, my friend is smiling because he's been able to do that. So it's a case of an SSC who was running PR agency. No, what? When we just saw the section says you should not be in the agency business. This fellow said, I am in the PR agency, I am doing PR agency. Public relations, media communications. So this fellow was taught that you are not entitled to benefit of this section, you are doing agency work. In addition to the problem which we will deal with a little later, so it says, section says you should not be in the business of agency. What is agency? We read contract law, what is principal, what is agent, and throughout history of the 1961 Act, Section 194H, brokerage commission agency, we had problems all across, and in different situations, different courts have given, trying to give whether this particular situation constitutes agency or not. What's the fundamental principle underlying as to in which situation will say agency? If they can put it into one sentence, and which is not in my sentence, what the Supreme Court said in the case of Bharti Cellular, and reiterated in the case of Future Gaming Solutions recently. Both are recent judgments, and very important to note, they say agent is somebody who brings into a relation of contractual relation between two parties. It alters the legal relationship between the two parties. If a person does not alter the legal relationship between two parties, not an agent. So unless that kind of thing is there, just because your label says agent, your agreement says agent, Future Gaming Solutions clear in this point, your agreement says your agent, that will not matter. What matters is what you are doing. And if what you are doing does not tantamount to changing the legal relationship between two parties, you are not an agent. Pattern is there. So that's an important point to note. And as we move on, see what happens. For example, somebody is driving on the road. He is driving in the correct path. Perfect. Somebody else comes and beats him. this fellow gets injured. For whose fault? He was not at fault. Somebody else is at fault. Somebody who crossed the red light, who was overspeeding, he gets his innocent fellow. So like that, a taxpayer is not doing any kind of professional work which the section is not applicable. He is not doing any professional. But the client or the customer, he deducts TDS as if it is a professional work, or it is TDS as if it is brokerage or commission. Instead, you can do about it. You have received a payment, that is itself the grace, because it's not a bad debt first of all. That's the first grace of the business. And then if TDS is come, you take credit, that's all. You are not so much bothered about the rate of TDS at most of the things. Some you will say, okay, request you to tweak it for future transitions that you will do. But just because your customer or the client has deducted TDS as if the income you are getting is either agency brokerage or professional, will that alter your status? It should not. It is, as I said, more similar to the somebody is crossing his lights and hitting you. But life is not as simple as we want it to be. And this Mumbai tribunal, so Jaipur tribunal, in this case of Airlink International, the Honorable Tribunal said, okay, your allegation or your contention, Mr. Taxpayer, is that you are not doing this relevant business of agency or commission income or etc. or professional income, but your client or customer has deducted TDS under 90 or H. Therefore, you are not entitled to demonstrate what action you took to correct this error. If he failed, this poor fellow miserably failed to demonstrate that he took some action to correct it. He was not bothered about it much. And he was denied the benefit of it, particularly. With due respect, wrongly, but these are the things which are playing around. We should be careful that this risk can sit on. Some client may ask you, sir, this has happened. You have tried doing something, at least put an email. You demonstrate that you have done something, whether it happens or not, you will see later. At least there is something. So doing this bit of action can probably be helpful, even though you are technically right in claiming that somebody else's mistake should not be should not bring any kind of misery to me. But then that's how we have to see. Another problem which is surfacing sometimes is this section applies if the concerned taxpayer is engaged in a particular business or he is the person who is carrying on the relevant business. Now, as far as a partner in a firm is concerned, does he acquire the status of a person who is carrying on that particular business? A partner in a firm is getting his salary, interest on capital and profits of business. Profits of business exempt, have no difficulty. But he wants to claim 44 ADA or AD whatever. And the allegation comes from the department, sir, you are not carrying on the business, it is the firm carrying on the business. Therefore, only firm can get the benefit if at all, you in your own hands cannot get. So, there is a firm, it has 4 partners, all as in totality the firm is crossing the threshold, partners are getting salaries and interest, they are being subjected to their independent assessments as business income. They want to claim this benefit in their own hands. What's wrong? I don't think there is anything wrong. But what the courts have looked at it. Honorable Batra Sai, in 2020 said, no, you are not getting the business. It's the firm getting the business. Thereby denied the benefit of the presumptive rate to the taxpayer. Very recently, in this 2026 only or 25, in the Delhi tribunal case, in the case of Ram Gupta, the tribunal had you are entitled. So on one hand we have some favorable judgments, we have some adverse judgments. Unfortunately, the adverse judgment of High Court and the favorable judgment of tribunal. The High Court judgment is elaborate, the tribunal judgment is very sketchy in terms of deliberation of the decision. So you have 2 obstacles therefore. So when we have conflicting judgments, and we have conflicting judgments for almost everything under the sun. That's the beauty of the profession. So which way to go? So there are certain guidelines. One, higher firm versus lower firm, high court versus tribunal. Within high court is a larger bench versus division bench. Jurisdictional high court versus non-jurisdictional high court. So after crossing all those things, you still find that your case is in a weaker footing in terms of jurisprudence, in terms of case laws supporting you. Then you take a bold stance as to what we believe the law to be right. Okay, and then we have to have an independent analysis which can give us conviction enough to proceed on a particular path. Now, we see this dichotomy. Madras High Court is against Delhi Tribunal's favor. One superior forum. Secondly, not only that, it is more elaborate judgment. Therefore, we are not difficult. So, how to resolve this? So then look around, find something else. Where else we can get cross support from? There is an old judgment of Honorable Supreme Court in the case of R.M. Chidambaram Delhi. The case of agriculture income. Agriculture income earned by the partnership, whether exempt in the hands of the partner also, does it carry the same legal character in the hands of partner also? So the court there said yes, whatever is earned by the partnership firm, it carries the same legal character in the hands of the partner as well. What they say is, the salary of a partner is a business profit known by a different name. Essentially, legally, whatever the partner is getting as salary also is nothing but division of profit by a different mechanism, by a different label. This is implicit that the partner's share in the firm's income includes partner's salary. The test is that where the firm suffers loss, the salaried partner's share in it goes to depress the share of income. Surely, therefore, salary is a different label for profits in the context of partners' remuneration. The necessary inference they draw is the partnership is only a collaborative name of separate persons, and Partnership Act definition of you also see at the bottom of the slide that partnership is the relation between persons who have agreed to share profits of business carried on by all. Partnership is not a separate legal entity, it's a collective name for all partners put together. So therefore, it is all partners carry on business together is what partnership is. So therefore, by the definition of partnership itself, as per the Partnership Act, you should be confident to say that every partner is doing the same very business. So therefore, he is entitled to this relevant provision presumptively. This judgment has neither been referred to the Madras High Court nor referred to the Honorable Delhi Court. So sometimes we have to look for there's an old joke which is very favorite. I was a small kid that time. I don't mind, I may be digressing for a minute. In a dark night, somebody was, walking across the lane and he saw some other person trying too hard to search something under the street light. So this gentleman asked, sir, you're trying to find something, you seem to have lost something, what is it, can I help you? Sir, I lost my wallet, it just fell down. So he said, are you sure it fell down there only? No, sir, it didn't fall down there, it fell there. So why are you searching there? It's too dark there. So sometimes where it is dark place, it's not able to find the solution. We have to sometimes shift to the other place until you can find it. Of course, if the wallet is lost there, you cannot find it here. But at times you can find solutions elsewhere. So the agriculture income Supreme Court judgment helps us when we are basically not able to find a solution in the 40/80. So that's the short one I want to do here. Now the issue which kind of comes because see these presumptive provisions, as I said, the basic objective is to simplify things, don't maintain the books of accounts. On a lump sum basis, we will say, okay, this profit percentage is to be applied to your gross receipts. We are not maintaining books of accounts, independent individual expenditures, deduction, etc. does not make any relevance. The tax department officer, he says, my targets are not met, I have to do something. And then he says, sir, you have so many cash entries deposited in your bank account, please explain me one by one. And this fellow says, I am not maintaining books of account, don't trouble me, this is my gross receipt, which is more than amount deposited in bank account to different cash entries, etc., and even check entries, etc. On the top of it, I'm offering something else also. So my aggregate turnover and offering is more than the deposits. Please spare me, apply this presumptive rate, and let us live happily. Officers know you have to explain these entries. If you not explain these entries, I will make additional section 68. Now these kind of cases have also reached courts. There are two kinds of rulings which are emerged. One set of rulings, largely both set of rulings are favorable only. The one set of rulings says that unless the department is able to establish that the so-called unexplained entry in the bank account is not from this relevant business. The business which the SSC says that I am carrying on this business which is eligible to presumptive taxation, unless the department can demonstrate that it is not from that business, something else is there. Unless that proves, you cannot really touch this fellow. You have to apply presumptive taxation only. This is one set of things. This is more playing on onus, on whose burden it is. The principle on burden of proof is apparent is real unless proven otherwise. To prove that particular income is taxable is on the department. To prove that the deduction is eligible is on the SSC. To prove that the income is exempt under particular section is on the SSC. So applying these principles, when this is a case of an entry which the SSC says is not taxable separately, the department also says not separately taxed under section 68 kind of a situation, then the department alone is to prove that it is not from this business. But the onus is like a pendulum which keeps shifting here and there. And in that process, when the officer asks you, please tell me, what are you doing, what kind of transactions have happened, what kind of customers you have interacted with, you have to give that necessary data. You can't say, no, I will not cooperate with you, and then kind of strangulate the whole process the officer wants to carry out and then try to take advantage of the onus to do that, will not help. So, applying these principles, you can still come out of it. There is another set of ruling which says, very technical, very hyper technical of view. This is section 68 kind of provision, which is 102 in the new law. It applies. The language of the section is amount or sum credited in the books of accounts. And there is no books of accounts maintained. There is no question of amount credited in the books of accounts. Bank document, the bank statement is not my books of accounts. The bank books. It's not my books of accounts. So that I know people smiling because it sounds too ridiculous the way. See, what has happened is section 68 came into existence in 1969. Then the people in this room, the generation to which belong, we have some benefit of falling back on 1925 also. The next generation will find it too hard to relate anything to 1925. In the 1925, there is no provision which is similar to 68. There is no provision. But nonetheless, if you have some credits, if you have some investments, if you are unable to explain the source and nature thereof, it was held to be taxable. Without the recourse to any statutory provision, because the presumption was, you who possess this, you are not able to explain where did it come from, must have been unaccounted in. The courts blessed it. So, a very hyper-technical reading of section 68 therefore seems to be misplaced with due respect, and therefore that kind of argument you should not take, I believe. To say that, no, this is bank's books and all, not my books, it's a very easy argument to take. What really matters, success matters. But the process of success, if you take an argument which is audible, patently, that argument will save you to maybe 1 level, 2 levels, but at some point of time it will fall down. So therefore it's also important as to when we support the client, what kind of arguments we place. Simply citing 2-3 rulings here and there may not be a very long shot. It can be shorter. So therefore, even though we have two set of rulings, our emphasis should be on first principle that unless you prove it, it is same business. So these are the kind of rulings which say that section 68 does not apply when I am not reading books of accounts at all. judgments. See, the question which I have framed here is what we discussed just now. Not maintaining books of accounts is a privilege here. Can that privilege be taken as a shield to introduce unaccounted money? Conceptually and ethically, if we see, it is not. It cannot be a license for me to do anything of this. But emotional and sentimental arguments have, in my personal view, no place. So if we legally formulate this, the question therefore becomes is, can section 44 AD and 68 or 58 of the new law versus 102 of the new law, can they coexist? If it is possible to apply both the sections, and what prevents the officer to do so? Our argument of the taxpayer was that no, 68 cannot apply because I am governed by presumptive and that should be end of the matter. Nothing else is to see. But you should not see anything else which is conflicting with the scheme. 68 does not conflict with 4180. It supplements, complements. It is addition. It can stand and implement. Unless you find a place where crossroads and then you cannot take, you have to necessarily choose one of them. Then only you can take this as an argument, not otherwise. We proceed to the next issue now. Whether the turnover on which I have to apply this presumptive rate of tax, either 6%, 8% or 50% depending on which section we are applying, the turnover should be treated as inclusive of the service tax, GST, whatever, or net off. Sorry?
Net off.
Net off. Anybody who says gross?
Taxable value on.
Sorry?
Taxable value on.
Taxable value?
Is net off.
Yeah. Any reason you want to give for this, sir? Why did we say net, not gross? What is the legal argument for that?
Tax collected on behalf of the method of accounting.
Sorry, sir?
Method of accounting.
Method of accounting. Any other argument?
Tax collected
Tax
is on
collected
behalf of the
is
government
like-
again.
Just collecting it on behalf of government and it is not a government.
I am collecting tax on behalf of the government, I will pass it on. I am collecting tax on behalf of the government to that extent and definitely. I will pass on it to the government. It depends, it's you or me. I am very serious. I will not pass on. I will try to see how to do. This argument is commercial argument. This argument is a commercially driven argument. Or in some sense sympathetic argument. Now problem lies when we have to formulate legal argument. Because and for that matter, at times commercial argument will sail through more easily than the legal argument. So therefore it is always important to have both legal and commercial and sometimes sentimental arguments also. I am told, there used to be one very prominent lawyer and he could even succeed in cases by just opening the case, not the appellant is homemaker who's been deserted by her husband, raising 2 kids. The heart of the judge is already built. He also human being. It happened with me once. There was one Purohit Panditji of some temple. His daughter got married, and on the marriage occasion, he showed that I had gifted a car and some 5 lakhs worth of car that came some 2 years back. He said how the money came. He got some certificates or some confirmation letter signed from the people in the vicinity of the village that I have gifted 20,000, 25,000 like that. He said I have literally this. So I research on case laws after case laws, legal arguments, sections is this. I should have the courtroom. I said these are the facts. This is my submission. The tribunal member asked one simple question to the leader: are you married? Yes. Did you get anything in the wedding? Yes. Why would you trouble? Seriously, no relevance of you didn't pay any part of the legal arguments. Case head in the game. Only the. So what I'm saying is there are occasions when sentimental arguments, emotional arguments will play. There's cases where the technical legal arguments have to fall back on. So eventually in your package there should be everything. And you have to see in which place, which situation I should place what. Your package should be everything. What you have to show first and what you have to show second. That's what you have to say. So see, coming back to this thing. So when you see that sales tax, service tax, if GST etc. are to be included or not to be included in the turnover of applying the profit rate. Section 145A of the 1961 Act, and I'm sorry, you have still not memorized the corresponding section of the law, that says for the purpose of computing your income under the head PGBP, the sale should include the taxes. And the section says for the purpose of competition to include section this tax and all, then how do we come out of it? Now that's a legal question. How do we give a legal answer to this? They say that your method of the books of accounts, I don't care. You have to govern by the section already. So this is judgment of Honorable Tribunal in the case of Mumbai, China shipping container, which is top on the screen. It says, tax is an integral part of the gross receipts. Service tax has to be included. And the tried upon an old judgment of Supreme Court is a Chonagi Sales Bureau. Chonagi Sales Bureau has been very, very famous, and being used by the department across for these kind of things. Which said that what you recover as a tax is also part of the trading receipts. Because that was, as I said, mischievous, like he didn't pay taxes. He recovered from the customers, but he didn't pay tax. The court said it has to tax as your income. You recover something as a tax, but you don't pay the government. It's your income. It's a trading receipts. So relying upon that, the judgment saying that it's a part of the gross receipts. So how do we take that now? Especially your 145A and new section is 277. It says so. So there has been one set of judgments. So as there are certain sections in presumptive scheme itself. Just 44 AD are one side, 44 BB, BBB, etc. are set of sections, which is now 61 of the new Act. These set of sections says the turnover of the money received on account of providing so and so services. You apply the rate of profit on the consideration received on account of providing so and so services. So the moment that the language is used, the court said the service tax you have collected is not on account of providing services, but on account of legal requirement. So therefore, that legal answer is you don't have to add that to your gross receipts. But that kind of language is not clear 44 AD and ADA. How to solve that we have to independently tackle that. But in this kind of section also, one court looked at or set of courts looked at the language saying on account of. It follows some further words are there that on account of they say in connection with providing services. The on account to we can agree, but it is still in connection with services. Another I could added that also for that reason. So two different set of courts looked into two different links of the very same section. One said favor, other said against. So in a situation like this, my approach, and I may be wrong, legal answer would depend upon like this. What we have to ascertain is what is turnover. What is turnover? Turnover is not defined specifically to include or exclude something. That turnover conceptually, as per dictionaries, as per other things, it can include taxes, it may not include taxes, both the interpretations are possible. Both the interpretations are possible. One school of thought which is easy, which I don't really like, is when the two interpretations are possible, apply which is favorable to the taxpayer. Last resort, I don't really like it. When two interpretations are possible, see what is contextually more appropriate. So first statement is that turnover is not defined. Second statement is it can carry both the meanings. Third statement is contextually what is more appropriate. Then comes the same arguments which you took in the beginning. What is the objective? Objective is to ascertain the profitability. Objectives are the profitability. Will profitability depend upon the taxes? Now the third one more things come. Presumption should be, unless proven otherwise, presumption should be I am honest. Presumption should be that I am bona fide. Presumption should be I deposit my taxes, unless proven otherwise. Presumption should be I would deposit my taxes, unless proven otherwise. So therefore, and demonstrate the case. A limited, B limited. Quantity of units sold 10,000, quantity of units 10,000, price per unit 40,000, price per 40,000, 400 crores turnover both. Sorry, who have not reading the sections, but not only for the sake of arguments. This fellow applies regular tax rate. This fellow applies, say, some concessional tax rate, or because of some reason, compounding scheme he's opted for. So his tax rate is less. So his turnover is less, his profitability less. But practically they are identical. Second thing, today my tax rate is this. Next year tax rate increased. Everything remains the same. Will profitability increase, decrease? No. So by giving these kind of methods and syncing it with the contextual requirement, you can bring the same answer with a legal approach. Now, let's step to another issue. The section says you should be carrying out a particular business for you to be eligible to this scheme. You are eligible, you are carrying that. We have set up other business also. If you are carrying some other business also, that's not the only business you are carrying. So will it turnover include only the relevant business proceeds, or will include other businesses also? Now, conceptually, logically, if we see, no, it should not include other business streams. This section is meant for only this kind of set of business, then other things should not come. That's the conceptual, logical answer. But when we see the framework of the law, when we compare it with other sections, so 44 ADA on one side, and 44 BB, BB, triple B, DDA, which is new section 61, new section 58. If we contrast the language used therein, the language used in 61 of the new act vis-a-vis, which is 42 triple B, triple B, etc., they clearly say it is percentage of the money on account of or the consideration account of ABC. So very watertight language here. Here the language is gross receipts of the eligible business, also not written. Gross receipts of the business. So because of the flexibility in the language of 44 ADA, it may be possible, I'm not idealizing, it may be possible to take a view that everything you can aggregate for applying the concessional or the presumptive rate.
It has to be in the income under PGBP only, right?
Yes, yes, nature of it will not change. Nature of it will not change. And then, whether once having computed this income in this fashion, whether disallowances like non-deduction of TDS, non-depositing taxes, etc., GST, etc., in 1043B, whether these disallowances will operate or not. Now, as we just saw, argument I had taken was that presumptive nature of computation should not give you a license to flout other provisions. That's a logical thing, legal. But this section says that section, once you compute under this, then section so and so to so and so, which is 26 to 54, I think, of the new law, will not operate. And if you go literally by that, then these disallowances will not operate. Even if you have not paid your taxes in time, even if you have done some non-compliance of TDS, etc., those disallowances will not operate. Is the literal reading and the first blush. This section really says so and so sections will not apply to the extent that they are contrary to this. The problem lies here. Sections will not apply. They would have said simply that if the language of this provision was that section so and so to so and so will not apply. Matter would have been very simple. They are not applied, they are contrary to this. And notice what is contrary. What is contrary? Contrary is something which cannot coexist. If something can coexist, means you can make computation, base computation as per this provision, and then on the top of it make some dispatch. It's possible. It's not impossible. They cannot coexist. Then there is a difficulty. Then you will say that okay, only this will operate. So therefore, there have been lot of jurisprudence slides there on the slide deck, and this PPT can be shared on the branch side. So the judgments both the sides, and predominantly judgment in favor of the taxpayer to say these sections will not operate. But please bear in mind, fundamentally it doesn't give a license to flout the other provisions, and in my humble view, they are not contrary to the scheme of the code. And therefore, there could be difficulty in sailing through in the long run. One more element, and then we move to the other issues. If the tax of the taxpayer is borne by the client, I know who's that courageous client or so graceful that he is getting tax on the receipt also, but if at all somebody is fortunate in that means the judgment says that tax so borne is also income of the recipient. That flows from section 199 also. So one important change which has taken place in this scheme is the new section 58, which captures 44 AD, ADA, etc. It has a specific subsection which says loss will be denied. So no loss, no other deduction. Earlier, this kind of provision was there in 44 BBB, etc., which is now in the section 61. So denial of loss set off has been now extended to 44 AD, ADA kind of sections also. There is some catch, as I said in the beginning, people, in the litigation field, they still try to, find something to say. So the language of 1961 Act was very strong. It says notwithstanding anything written in section 72 which gives you set up of the proper losses. Notwithstanding that, loss will not go. Now, the new law broadly, most of the sections instead of notwithstanding says irrespective of or etc. But this particular subsection neither says notwithstanding nor says irrespective, nothing. It's a subsection lying in the head of computation. It's a subset of the overall scheme of computation of PGBP income at a particular chapter head. And says loss will not be allowed. It does not override the, because what will happen is first you will compute your income under the head. Then you aggregate it. At the aggregation stage, set off comes. So at the time of a certain gross total income. And that stage is nothing there in the scheme to deny. So placement of section fundamentally should not alter the impact. Even if this subsection was placed elsewhere, ideally should carry the same weight. But still, we can still try exploring an argument that its placement is in the head. At the after head computation, you go to aggregating different heads, and at that level, you are entitled to set off, and that set off is not overridden by this. That's the most important. That set off is not overridden by this. That's a kind of lacuna, and somehow it has been threatened, but that's something we can be explored. And that's not a reason. So just regulation. The other matter which is recently come in this budget is the famous ruling of Supreme Court of checking that if you are not paying your provident fund, DSA, etc. in time, then permanent disallowance used to happen as far as employee contribution is concerned. Now, despite the Supreme Court judgment being against the taxpayer, lot of human cry, etc., the new act creates a provision which places the employee contribution at par with employer contribution, meaning there in either cases, if there is a default in payment, when you make the payment, at that time it will be granted the deduction. It is only deferment till the time you make the payment and not a permanent disallowance. One very interesting something which is very close to my heart, because this is something which when I did my CA finals, I get returned to the then CBD chairman that you need to look into this. It has not changed. So therefore sometimes something which has not changed also gives you different kind of experience and pleasure. It's a case of sale and lease back. You just take a look at the illustration and we can try to appreciate what I'm telling also you. There is X limited a taxpayer which is a seller and Y limited is the purchaser. X limited in a particular block of assets has got three assets A, B, C. A is value 30 crores, B is value 20 crores, C value 5 crores. So total 55 crores of block WDV in X Limited's hands as of now. What it does is X Limited sells A and B, only A and B, at only 1 crore value. WDV is 50 crores, A and B put together WDV 50 crores. It sells to Y, has to be group company only. Otherwise nobody will do this charity. Sells to Y 1 crore only, throw a price as to be done. And Y Limited immediately gives it back on lease. So therefore no movement, only paper movement. Money movement is only insignificant that is. In this arrangement, sale and lease back, what will be the WDV in the hands of X Limited? X Limited WDV was 30, 25, 55. What is reduces? 1. 54 it continues to have WDV on which it can take depreciation. We'll come to other problems later. As of now, this WDV is reduced by 1 CR. What is the cost of acquisition or WDV in the hands of Y Limited buyer? He is paid only 1 crore. Immediate reflection is he is paid 1 crore. 1 crore is the value. That's immediate reflection. Now, the old provisions, explanation 4a to 43.1, 43.1 defines the actual cost. And the new provision is 39.48. Let's take a look at what it says. It gives you circumstance in middle column and consequence in last column. What is circumstance? Circumstances where an asset is acquired in SSC from a previous owner. Y Limited is SSC acquiring from previous owner X Limited. Subsequently, asset is given back to lease to the previous owner by way of lease. That's our case. A asset was being used for the purpose of business by the previous owner. Yes. Depreciation has been claimed by the previous owner. Yes. Determination of actual cost. What does it say? Actual of the asset shall be returned on value in the hands of the previous owner.
This is how it was old accounts.
They thought, lawmaker thought 55 crore worth of asset I will sell it for 60 crores, 70 crores, 80 crores. I will enable the buyer to claim higher depreciation. They only one track thought. The reverse gear mara, something else happened. So if we come back to our case study, what it really means, and I am not doing anything. I am only compliant with the law. Law is only forcing me to claim depreciation at 50 crores. We are treating that to be actual cost and I paid only 1 crore. So if you read this explanation per se or this provision per se, my payment is 1 crore. What is my actual cost of WDV? 50 crores. Does it make any sense? It doesn't make any sense. But then, it is the law. What if the law does not make sense? We are many times caught in the situation that law does not make sense. Then do you follow sense of law? Sorry? Which is beneficial. So, when the law does not make sense and it hits the consciousness, with my limited knowledge, the answer is like this. If the court can find some way to interpret it in a different fashion, if there is any possibility to interpret the language in a different fashion, they will interpret that way. To prevent mischief, to prevent absurdity, to prevent injustice. But if it is not possible to interpret in either way, it's a problem. Then the court says in multiple times, if the law is harsh, go to the lawmaker. Either it will be harsh to the taxpayer or it will be harsh to the department. If it is harsh, go to the lawmaker, don't come to me. I will interpret the law it is. So, this I kind of thought of 25 years back when I was living in City Final, that time we didn't have GAAR. Now we have general anti-evidence rules. Will this kind of transition into a general anti-evidence rules? The starting point of GAAR is there should be an impermissible avoidance arrangement. And testing parameters are you creating any transaction rights and liabilities of the transactions are not at arm's length. Price but not price. Arm's length price is transfer pricing. GAAR says rights and obligations are not at arm's length. Is it creating misuse or abuse of law? Is it absence of commercial substance in that? Or the use of malafide in the manner which transaction is carried out? So, difficult phrases. I don't have a straight answer for that. I will be able to place some arguments, but not so easy. But there's another dimension to this. GAAR has a threshold of 3 crores of tax liability. Now, below 3 crores, they say we will not trouble ourselves, neither you. So the question therefore remains whether is there any other specific anti-evidence rule prevailing here, which I don't think so is there, or whether judiciary can come say and the judicial anti-evidence rule will apply, which they have kind of reignited the problem by Tiger Global case of Mauritius treaty benefit. So subject to that, there are so many catches which is there in the law, which were there, which continue to remain there, and our objective should be to kind of reread the law and to sense where else we can do something. Before we part and conclude this point, there is a principle called rule of mischievous interpretation, or rather mischief rule of interpretation, which says that if the literal meaning is leading to mischief, then apply a different interpretation which suppresses the mischief. Again, the problem comes, is it even possible to read that clause in a different fashion? Because it clearly says, this is the situation, this is the cost. It doesn't give you any ambiguity. There is no difficulty in reading the provision. There is no ambiguity in interpreting the provision. So in such a case, even the courts have held that you cannot apply any mischief rule of interpretation and arrive at a different meaning. We now proceed to yet another topic for today. We are very conversant with the point that if tax has not been collected at source on a particular expense, then we have to suffer dissonance. Now within that simpler statement, there is a subset. If you deduct tax, it was supposed to be deducted say 5%, you deduct 1%, or for some reason it is not properly deducted. Rate is less, or out of say 12 transactions in a year, one transaction somehow got less. 11 transactions rate calculated, one transaction there is no TDS. So what will happen in such a scenario? There have been one school of thought that disallowance in this section will operate in a case of non-deduction. In case of non-deduction, if there is a short deduction, there is a specific statutory amendment which took place in section 201 of the 1961 Act. So at some point of time, section 201 also had a similar non-deduction consequence of assessee who is supposed to have tax becomes assessing default and gets to pay the tax from his own pocket. That section got amended to even cover the case of short deduction. But there are no similar changes made in 40. So based on that, courts have said that no, the only consequence possible is treat him as assessing default, dissonance cannot operate, and if time before 201 is over, go home, nothing can be done. So the question therefore is it in a case like this? So two situations we are having. One, a case of short deduction across all transactions, which we say that there are judgments to cover. How far they are correct, or how far we can really write on those judgments, we see. And case where 11 transactions currently have paid the tax rate, one transaction not applied. Whether that one transaction will be treated as non-deduction transaction or you see on a holistic year basis, there is a short deduction only, not a non-deduction. Whether that payment will be fully disallowed or other 30% whatever depending on the relevant provision. Any thoughts, any arguments you want to share on this?
It's a rate issue, then it's a case of short deduction. But if the transaction is totally missed from previous one, then it's a
So rate deduction, then the question is whether rate issue do you sense at a transaction level, payment level or
at a transaction level.
at a transaction level. So these are rule laws of judgment. This is short deduction, this one should not operate. There has been this judgment in 2015, Kerala High Court. One more judgment which did not bother us so much. We said short deduction also you have to make corresponding dissonance. They say that when section 40A says deduction as under so and so chapter, then all sections of that chapter of TDS are equally attracted. And if there is default under any of the sections, then you have to suffer the disallowance. That's this Kerala High Court said. So far we did not bother much. Just 2-3 months back, Honorable Delhi Tribunal has held in the case of covenants. They said no, we will apply the rule very strictly, and for strict reading they have referred to Dilip Kumar Supreme Court case and said that disallowance has to operate even if there is a case of short deduction.
With regards to exemption and deduction.
So that's Dilip Kumar's case is a very different case. Proposition let down for strict interpretation is in the context of exemptions. This is a case of disallowance, it is not technically applicable, but keeping that aside, the question which I posed was, do I apply this non-deduction or less deduction kind of thing at a chapter level, at a section level, at a recipient level, or at a payment level? Now, if you see the section very closely, section itself says any payment on which tax is deductible but has not been deducted. The section's language itself is very suggestive and clear that any payment on which this is not done, so it applies at a payment level. So therefore, in a year, if 11 payments are currently, taxes applied, and one payment is, totally DDS is left out, that particular payment will suffer relevant disallowance. Is that understanding clear? There is one more very interesting facet in the language of this section, and that supports our stance. The language of the section says, if tax deductible under so and so chapter, if tax is deductible under so and so chapter, and such tax has not been deducted. No, the such tax suggests that the very tax which was deductible should be deducted, which kind of suggests that disallowance will operate. But when you see the proviso, or in the new scheme of writing, it is 2 clauses are there. It says, very interesting. It says if tax has been deducted in the subsequent year and paid, you will get deduction there. Which tax? Such tax they don't say. Say tax has been deducted. How much rate? They don't say. According to so and so chapter, no. As deductible, no. Nothing. When they say it doesn't say the tax has been deducted. If you say the tax means the very same which has been spoken previously in the same clause. Say tax has been deducted. That's town tax. If even you apply 0.01%, theoretically speaking, you should be able to claim deduction next year. So some deduction has taken place is what the clause gets into. And if you say, then the question is how to harmoniously read the previous clause and subsequent clause. Harmony should resolve the favor of taxpayer or the tax department. A lot of users will come into, but then for the time being we can, get some comfort in that language in the clause which is after the main body.
Which is the new section for this, sir?
Similar view. New
For
section.
disallowance.
Sorry?
For disallowance, 40 AI.
37.
37.
37. That also similarly worded.
Yeah, and one more thing, suppose we have disallowed 30% in case of resident and 100% of non-resident. After that also department can give notice
For what?
for like you have not deducted tax.
Under 201.
They
As
can-
assessing before.
and they can charge 220 also, old section 220.
So there have been some jurisprudence that both these cannot operate. Ideally, both of these should not operate, and based on the amendment in 201 and 40A also, that if the recipient has paid the tax, then neither 201 will operate nor 40A will operate.
No, in that case we have to get CA certificate and all.
So yes, and that's a different dimension. Why I am referring to this is just kindly deal with me 1 minute. What I am trying to say is, at some point of time there was no linkage between 201 and 40A. But in the light of these amendments, first amendment came in 201, then 40A1. With these amendments, they have now statutorily linked that. You can try to say that no, now these sections are interlinked, and therefore entirely it should be seen as if they are interlinked. If by 201 for 201 purpose there cannot happen this thing, then for this purpose this one should not operate. They are complementing each other. Therefore, we should not recover taxes as assessing default as well as disallowed again recover tax. Double jeopardy should not happen for the same default. A double jeopardy can also fall back on the constitutional framework. This again is an issue which is quite prominent these days. As you would know, at some point of time, people would do amalgamations or slump sales and purchases, and in that process generate what is called goodwill. So goodwill technically or logically is what you earn based on your conduct and your goods quality, service quality over your time. But accountants' goodwill is slightly different. Accountants' goodwill is to pay the purchase consideration for a set of assets. Individual value of assets is less, purchase consideration is more. The difference is accounted as goodwill in those accounts. So many taxpayers tried doing this. There was judgment of Supreme Court against Swiss Securities, which said goodwill is depreciable asset. Because Section 32 has a list of intangibles: patents, trademarks, copyright, this, that, franchisee, license, etc., and any other commercial or business credit. So the court said the limited issue before the court was whether goodwill satisfies this last limb of any other business or commercial right. Court said yes, sir. Thereafter, left, right, center, many people entered into group companies, amalgamation, demerger, mergers, slum sales, slum purchases, and thereby generating goodwill and claiming depreciation that continued for a very long time. In a couple of years back, when the government really got tired that all courts are granting payroll judgments predominantly, with some handy judgments maybe less than 5%, 2%, which are adverse to SSE. This is not in sync with what the lawmaker felt that what we want. They amended the law to say goodwill is not to be depreciated. No depreciation goodwill. When the goodwill depreciation done away with, then as I generally say that tax is not a subject. Tax is a race. Tax is a race between tax department and taxpayer. Sometimes they are ahead of us, sometimes we are ahead of them. So it's all, whenever there is an amendment to try to kill the tax planning ideas, the tax professionals will evolve and do something new. So once this kind of thing was on the sunset side, the taxpayers and professionals thought of newer dimensions in the whole scheme. Because Section 32(1)(2), which covers intangibles and tangibles, the intangibles covered are know-how, patent, copyright, trademark, license, franchising, and other commercial business rights. And once this depreciation on goodwill chapter got closed, the necessity arose that we look at other intangibles, whether the transferred entity has got some patent, some copyright, trademark. Generally, trademark will be there. How much value we can assign to that? some DCF valuation done by some valuer, best efforts made, still not reaching that level of point where we will give you depreciation satisfaction. Know-how, trade secret, everything put together. Customer contracts. I have contracts with my customers. So what's the big deal? Oh no, sir, I am going to serve them for the next 5 years. It's long-term contracts. Long-term contracts will give me sustainability in business. That has its own value. I should attribute something to that. So customer contracts. And then when that also got exhausted, then I have fantastic workforce. Now going forward, AI will kind of take over. We will see what happens then. I'll say I have AI. But I have fantastic workforce. So if you start hiring people afresh, you will take a lot of time to assimilate a set of people which can function like this. So this assembled workforce is another intangible which is highly valuable. And then they search, where can we find support for this? OECD transfer pricing guidelines. OECD transfer pricing guidelines say various intangible workforce is one of them. Oh, was sorted. Argument placed before courts, tribunals. Sir, I have got assembled workforce. It's an intangible as per the DB guidelines also. Internationally claimed accepted. Therefore, whatever money I have paid over and above value of this as acquired is intangible workforce which I have got. So, just to illustrate, the WDV of the different assets, land, building, etc., 35 crores. And some valuer came and did his best efforts and arrived at say 46 crores of fair market value of assets, and then consideration paid is still above that 60 crores. Incremental 40 crores. Brilliant workforce. So these are set of judgments which say that workforce is intangible asset, can be claimed as depreciation can be claimed on this. One or two judgments I am told that they have even treated the revenue expenditure too far-fetched, because anything you pay to acquire business as a whole can only be your capital expenditure, cannot be any expenditure in my humble understanding of the law. But therefore I am not dwelling too much on that, but yes, good deal of judgments to support that. It's a intangible, incremental paid is depreciable as intangible. So I have two difficulties in that. And please don't say to me, you have difficulties, you handle your difficulties, not others. Because my difficulty can be your difficulty tomorrow, you have that situation. The challenge is, this section 32 when it talks about depreciation for intangible, tangible, anything, it has one important limb which is asset owned by the assessee. Asset owned by the assessee. That's one thing. Secondly, in the limb of any other business or commercial right, what can fall? If we see a little more technically, it has to satisfy something which is called the principle of ageism generis. It should be of the same category what has been talked about in preceding this thing, which are predominantly rights in rem, trademark, patent, copyright. They're called rights in rem because they operate against entire world. For example, I have a patent. Nobody under the sun can use that without my permission. The right against entire world. But if I have a right, contractual right with my customer and client, I can enforce only against that person, not against the rest of the world. So these kind of rights, contractual rights, or even workforce, I can have some right against that employee, and that right is also what? 3 months notice period, not beyond that. 3 months notice period is a capital asset, depreciable. And ownership, who can own the employee? Ownership test, my humble understanding cannot be met in this case. So therefore, it can be a very risky proposition. As of now, we have so many judgments in favor of the taxpayer. But is there a better thing to do? Is the 14 crore extra paid in this kind of case a sunk cost? Is it that total waste which I cannot take any tax advantage? I'm not seeking any unfair advantage. I paid that money. I paid that money. That's a capital expenditure. You don't give me reduction either as revenue. You don't give me depreciation. Where would it go? It's a blockage in the whole chain of the things then. There should be some treatment it should get. So if you look at from that premise, I mean, what I'm going to say may not be perfect, but I urge all of you before implementing anything of that sort, just do your own deliberation. So it is not covered in the slide. Maybe in the last minute you are trying to add certain things which should not get added. Income competition and disclosure standards (ICDS), which are mandatory to be followed for computing income under the law. This income competition and disclosure standards (ICDS), they say one of these standards ICDS 5, which says that if group of assets are acquired against a consolidated consideration, then apportion the consideration amongst the assets acquired on a fair basis. Apportion it. Once you apportion it, then entire 60 crores paid should get allocated to these assets in some of the other fashion. And best fashion is whatever valuation somebody has done on that registered valuer's basis, his aggregate is 46 crores. You allocate 60 crores in the ratio in which these values are appearing. You will get a lesser depreciation rate of relevant assets. Some of it will go to land, will not depreciation at all. But as against taking a stance which will fall flat few years down the line in some code, to take a stance which is more sustainable, which is legally sound, and does not result into sudden tax shocks. And there is a judgment of Banana High Court, which also slightly on a different fact pattern but supports a portion of consideration amongst multiple things acquired and consolidated. Maybe with this we can take a break. If it's the right time, I don't know. Or if you want to continue, we can continue for 15 more minutes. Will continue? Continue? Follow. So this next topic I am taking is a case of incentives. So various government incentives, subsidies, schemes to facilitate your business, profitability, capital infusion, etc. have been there since the business had been existing, because you have to boost economy by various means. Today we have production incentives, we have customs pay, we have various schemes to alleviate the import duties, etc. So what is the tax treatment we should be giving to these incentives? Subsidies. This topic is being evergreen, and only the shades of green have been changing. How initial arguments were, on one hand government is giving this 100 crores to me, then expecting me to give 30 crores back as taxes. What's the point? Effective subsidy is then 60 crores only. So initially courts accepted that yes, makes sense. Government wants to give it properly. Don't give it from one hand and take it from the other hand. That makes sense. But this argument did not survive for very long. The courts therefore started getting into when it can be taxed, when it cannot be taxed. Because not every incentive given can be an income, and not every incentive given can be a non-taxable capital receipt. So the dichotomy was, or the divergence of views was, when it can be a capital receipt, non-taxable, when it is a revenue receipt. So capital receipt would be when it is for an objective of improving the skill of industrialization. It is difficult to work and set up industry in a particular zone. There is very less industrialization in that geography. To boost development that we are giving this thing. Huge capital investment is required, we are giving capital subsidy. It is given to meet the cost of the project. So those kind of schemes, which will tell our objective is to increase industrialization, to help you, complete your meet your cost of capital of the project, etc. Those kind of schemes were said to be, falling in the zone of capital receipt, not chargeable tax. Subsidies given to meet those things. But those transport subsidies means to have a profitable situation, because cost of manpower, cost of transportation is very high in the particular zone. So certain kind of schemes to incentivize and have you a profitable situation treated to be as revenue receipts. But the taxpayers don't want anything to be under revenue. So the fight continued. Even those schemes which kind of fall into that zone, or beyond a point of time, the lawmakers felt that let us have a different scheme of altogether. Capital receipt is not what we want it to be. Whenever it is to meet the cost of a project, we will reduce it from the depreciable values of the asset. So introduced an explanation 10 in the section 43(1) to say that when you are getting a subsidy grant, etc., to meet the cost of the project, even if it is not identifiable to a particular asset, but it is to a group of assets, even then it is to be reduced from the cost of that group of assets on a proportionate basis. Now, the taxpayers still they desire to treat it as neither reduction from the WDV cost nor to pay tax on it, but to treat it as capital receipt. The desire continues. And the desire was met by another line of argument to say that the receipt of these kind of subsidies will require reduction from the WDV cost, etc., only when the scheme says it is for meeting cost of specific assets. If the scheme says it is for improving industrialization to increase the level of setup of factories in that area, it will still not satisfy the requirements of explanation. Then, despite having used explanation, still judgment still came in the favor of the taxpayers. Then the government thought that no, we have to do something more drastic to address this. Section 2, clause 24, definition of income amended to say whatever subsidy grant you receive is taxable as income unless it has been reduced from cost of assets. Either you reduce your cost of asset or you offer it to taxpayer. There is no other way out. When this amendment came, thereafter taxpayers said no, we have no other choice. We will not pay tax on it. We will now reduce from the cost. Now we will fall in line. We will now reduce from the cost. Now what is happening is taxpayer want to reduce from their cost base. Happily. But the department is chasing that. No, it is not meant for it is not meant for meeting cost of assets for industrialization in general. It does not satisfy the same explanation. Yesterday you were saying it does not satisfy the explanation. Today I am saying it does not satisfy the explanation. Therefore, no further reduction from the cost of WDV offer it to us. But then innovation never ends. Then the taxpayer say that okay, it is not to be still tax, neither reduction from the WDV, because what the explanation 10 is about actual cost. What the explanation 10 is about actual cost. If I have incurred the purchase price of the asset in year 1, and that year I have not received subsidy, I have received this year 2 or 3 later, because government takes some time to give you the. In year 2, it is no longer actual cost, it is WDV. In year 2, it is no longer actual cost WDV. From WDV definition, there is nothing to suggest that I have to reduce WDV. Therefore, neither the explanation here applies nor the taxability clause applies. I am still not taxable. No. Again, this argument, though it has sailed in some set of judgments, but there is an old judgment of Supreme Court in a slightly different context, which said that WDV, for the sake of ease, for the sake of convenience, we say last year's closing WDV is current year's opening WDV, but that's not the legal scheme. That's only convenience, that's not the law, that's convenience. Law is take original cost. If you read the section says take original cost minus depreciation availed till date is your WDV. So every year you have to redetermine actual cost. Every year you have to redetermine actual cost. Saharanpur Electric and Pune Electric Supreme Court judgments. So once you apply those judgments, you will fall into a situation where actual cost once done is not over. Year 2 also you will actual cost and reduce depreciation. In that process you will reduce the subsidy. There is no way. Now, if at all your schemes are in that zone, you have to reduce it from WDV or pay taxes. Then things don't even end there. Some of these schemes, and sometimes they feel it is the lawmaker also wants to have a play and fun with us. These schemes use the word not incentive, not subsidy, nor grant. They use the word reward. What made them use the word reward, God knows. And the tribunal judgments does not travel. Say reward is not a word used in section 2 clause 24, neither used in your explanation 10. So this is a reward not taxable. Neither. But this all if you get subsidy. So this is the welcome back. So just to kind of start again from where we stopped, the issue of subsidy. Just take a quick look at the history here. Kind of just to recap what we broadly discussed. So this company is into manufacture of some goods, and for new setup of a project, it has invested some 10 crores, and the government is giving a subsidy of 2 crores because the subsidy is meant for capital project, and to meet the cost of the investments, the company has reduced it from the assets block as per explanation 10, and should be good proposition to comply with. Now take a case here, there is no case of subsidy, but there is a loan taken. Loan taken to meet the cost of the project, and loan is due. Now in one case, first case we saw, it's a subsidy which goes to reduce the cost because it's meant for the capital project. If instead of subsidy it was a loan from the bank, and that loan you could not pay back, the taxpayer could not pay back, and on one-time settlement or something like that, the banker has waived a portion of the. What will happen to that? Now can it be reduced from the cost? It is not subsidy, it is not a grant, it does not meet the requirement of that scheme. The section 28 clause 4 would say any benefit or perquisite arising from business is taxable as business income. The section continues to remain in the new act in the same fashion. So this section got amended 2 years back to say, so what happened? Loan waiver was actually not taxable, capital receipt. Because they say it's a capital receipt when the loan is received. It continues to have the same character. Just because it got waived, there is nothing to say it becomes suddenly your income. At the time of receipt of the money, the character is fixed. The character does not undergo change at a later point of time. Only constants. The government, the department always wanted to rely upon the section 28 clause 4 to say this is a kind of benefit of perquisite you have got and it should be taxed as your business income. The court said that the section envisages something received in kind which is convertible into money, only then section applies, not when money itself is received. They said literally very going by this language, the section doesn't apply when you receive money. If you see something in kind which can be converted into money, that's a benefit of perquisite, which is capable of being taxed in clause. And they amended the law itself to say whether money or in kind, whatever you receive benefit from it is taxable. So now going forward, it becomes a difficult proposition to say no taxability. Loan waiver would in all probability trigger taxability as a business income. Subsidy can still go to reduce your cost depending on how the scheme is. There is yet another important Supreme Court judgment to consider in this regard is, they say if whatever cost of an asset is, that is frozen the moment you acquire the asset. The subsequent events do not have the capability of altering the cost. You have taken a loan, you don't pay that loan back, it doesn't alter the cost. You have taken a loan in foreign currency, later on the foreign currency fluctuation will there is a change in the liability, it doesn't alter your cost. That was the principle led on the court. So now we have section which says you have to alter the cost or your company requirement is there. Keeping that aside, principle was this. So principle continues to remain at least for loan waiver kind of situation that you don't have to reduce it from the cost. It is 28 for income only. What happens if the purchase price of the asset is written off? So there can be two situations in this. You purchase the capital asset and entire price was not paid, some part of the price was yet to be paid, and that price is not fully paid. Could be two reasons. One, the taxpayer is defaulting or not able to pay. Two, there was some quality issue because of which some reduction is sought. If it is a quality issue or some other problem of delivery, etc., and it is more a case of price renegotiation. So the cost is revisited, then it will reduce the actual cost. But in the case of non-payment of purchase price, it would still be a case of where you neither have to pay tax on it, nor you have to reduce from the cost because the event occurring after the asset has been acquired, relying upon the judgment of this Supreme Court. So diverse situations economically seem similar, whether you get subsidy, whether it's loan, whether you get purchase price renegotiation reduction, economically same, but legally they carry different legal implications. And yet another important thing which probably we can get from this case study is, this also has the same economic impact. You had a project, you wanted to fund the project, some investor is able to invest in the company, private placement, done, shares agreed to be issued. We would have studied this in our graduations. This doesn't happen in the reality as of today unless somebody who wants to really fudge some things. Application money, share call money, application money paid, call money 1 paid, call money 2 paid, call money 3 defaulted. Call money 3 defaulted, so full price of the share has not been paid by the investor who was agreeing to fund the project, and the company forfeits the whatever capital it has received. The forfeiture of share capital on non-fulfillment of the purchase of share conditions. You have received. Can we say, or can the department say it's a benefit? It's a benefit. It's a perquisite? Maybe. Is it arising from the business? It is again towards the capital side. It is not because you are conducting some business with that fellow. It's a gray area. So far there have been certain judgments to say that it is not it is not in the character of revenue receipt. It's a capital receipt. It does not satisfy your section 41, 28, etc. And therefore it is not a taxable receipt. So share capital forfeiture, whether it will meet the requirement 28(4) after the section has been amended, is a thing yet to be seen. Even for that matter, even though today's larger belief is that loan waiver will get taxed under section 28 and new section 26, but I have serious doubts. The government has addressed what happens. law, development of law is substantially a patchwork. Patchwork, you understand? This whole here with patch here, the whole here with patch here. You don't read. If we see capital gains, goodwill on capital gain, goodwill is a classic example. Section 55. So what happened? One Supreme Court judgment came. Transfer of goodwill not liable to capital gains. Why? Because cost of acquisition not returnable. Very good. Law meant to say goodwill, cost is zero. Then loom hours, cost of acquisition not returnable. Apply the same Supreme Court judgment, say non-taxable loom hours added to the section 55. Then trade permit, route permit, etc. One by one, over 2 decades, they kept on amending the law. Every time tax will come the new proposition, same proposition, but the new item, the new patchwork. It took them 20 years to understand why they were doing patchwork. They now, in 2 years back, they rebuilt the entire section. So whatever you have not paid anything is nil value. So in this also, first argument of taxpayer was it is received in money. It is not received in kind. Section was only to kind. They took only one argument. That argument they have addressed by amending the law. Now it is the time to get to another same section. Another argument of the same section is it is not a benefit arising from business. I am not in the business of raising money. It is not my business to raise capital. I do business after raising capital. Raising capital per se is not business. So how is the business arising from the, how is the benefit arising from the business? It's not. Once that argument reaches the court, I believe, and my personal belief, courts will say yes, it's not arising from business. Because when you raise capital, you pay expenditure on share capital issue, all expenses. They have been denied the deduction because not in the course of business. Section 30 deduction are not that because they say it's not business, it's raising capital. Then how does business when it comes for this benefit? Oh, I believe it should not be. So once this argument is taken again, it will go to the Supreme Court. Then again they will change the law. But by that time, you would have gained some advantage. Not suggesting that you should do this way, but one thing to say is there is still a lot of legroom to play. This I have already covered, whether WDE can be adjusted in one situation or not in subsequent years. So there is an important corresponding facet. I will come to this, maybe I will just take this case study and maybe I will come back to this proposition. There is a laptop manufacturer. It runs sales incentives for its dealers. Under the scheme, the dealers crossing specified targets, they are rewarded by, say, a 400. Hotel stay, airfare, etc., all taken care of. Then Mr. D, the dealer, he meets the target and receives a free ticket, goes and enjoys. He's got something, which is a benefit. It's not with it. It's rising for his business because he met the targets of his sales with his customers. So therefore, he's getting this benefit. Whether a fair value of that should be taxed as business benefit or profit arising in the course of business. Should he be taxed on this amount, which no money received, he's got tickets, he's got stayed in the hotel, he just signed that bill there and done. Acceptable, sir. Because 28 for clear now says any benefit or profit, he has to pay tax on this, no doubt.
194 are also.
194 are also corresponding. Okay. Now, if we just tweak this example slightly, he's not getting 400. What he's getting a luxury car. He's getting a luxury car. The luxury car he uses for the purpose of his business. Let us assume that to be an undisputed fact. He's using it for his business. As far as Section 28(4) is concerned, whether he gets a foreign trip or a car, his purpose it is there, it's going to tax it. The question therefore is, can he get depreciation on this? The cost is zero. Is the cost really zero? He has paid tax on an amount of 50 lakhs per car. He's paid tax on 50 lakhs as the purchaser. Can he get depreciation on that because he has paid tax on a hypothetical amount? Now take a case the laptop manufacturer says, sir, I'll give 50 lakhs cash. You buy a car. He says, okay. He takes 50 lakhs cash, buys car. 50 lakh tax, he gets is taxable. Car spending is depreciable, no doubt about that. If it is made a cashless transaction, his status given the car, it should be the one hand you will tax it, but you will deny depreciation, should that be fair? But the fairness, as any place in the law. So should it be cash transactions better? I like cash. No, I'm not asking you guys to give me cash. Well, I will not mind. So the point is, conceptually they should not stand on different footing. They should really get some economic benefit on that. But where is the legislative support for that? There are judgment laws. I'm sorry, those citations are not in this. By the time I'll kind of send this PPT to the branch, I'll incorporate those citation laws. If you're paying tax on a quantum, you're paying tax on a quantum on a situation like this, then the quantum which has been considered for tax purposes should be treated to your cost. Otherwise, it will be double whammy. So, and there is this judgment of Supreme Court cross brackets on. Some finished goods or raw material come from the parent company overseas. Indian company has received free of cost material. Now, say suppose 1 lakh worth of goods have come. Finished goods have come. Free. I paid tax on 1 lakh. I sell that for 1 lakh. Sale price is also 1 lakh. There again I pay tax. Is it not double taxation? It is double taxation of the same very transaction at the time of receipt also of the person. So therefore, to prevent double taxation, the court said you should get a reduction of the very same amount. Right? It becomes income in one hand because it's a corresponding business expenditure becomes deductible also. And following this concept, there are numerous judgments which have said yes, you should get depreciation, you should get corresponding expenditure. Now, the difference between the first and the second example is, first example take a personal pleasure trip for a trip. That expenditure cannot be claimed as business expenditure. But the second case is for an asset which is using for the business. So therefore, the business asset can be said to be depreciable for business purposes. So 28.4, 194 are not end of the road. They are just a new beginning. How to capitalize that transaction is up to us. In which situation we can do, we can also depending upon it's a foreign pleasure trip or a business benefit in other sense. Bad debts. Now this change from 1961 to 2025 has created a very interesting dimension. So what originally happened, and then there is some change in the recent budget. I will touch upon that. I'll first cover initial change from 61 to 25. Then in the second leg I'll cover what has happened in the recent budget. In the originally when the 25 Act came, now the section the bad debt provisions, before I go further, bad debt provisions such like this. Today there is a bad debt, you claim a reduction and you are very lucky to get a recovery from that debtor, you offer that as income under section 41. That's the scheme. At stage of bad debt expense, at the stage of realization, there is income. And before I go a little further, let me just give a brief background of how it happened originally. There was some taxpayer who had a bad debt and he realized money. He said, no, it's not income. The court said, yes, how can be income? You have not earned any income by realizing your bad debts. It suppresses your taxable profits. Understand? It should suppress your, it should really increase your taxable profit in the year of recovery, provided there is a statutory provision to say so. Conceptually, it is not income. It may be in the profit and loss account. For an accountant, it can be income. But from a tax perspective, conceptually it is not income and does not become income just because you claimed an expense in the past. That was Mohsin Rubber Company, Bombay High Court, in 1925. Then they introduced something called 41(1). When you claim a deduction, you get the money, it's an income. So it is a fiction in the law to say it is income, conceptually not income. It's important I think so, because when transition from 1961 to 125, what happened is, the 1961 Act said, the claim reduction under so and so section of this Act and recovered money, it is taxable. And 2025 Act said, if you have claim reduction under so and so section of this Act and recovered money, it is taxable. So gap occurred if a claim reduction of the old Act and claim got money now, this scheme did not have the ability to tax it. The linkage was not appropriate to bring in the deduction claimed in the previous law. And then there is one. So this similar thing happened in the 1922 Act transition to 1961. Same thing happened. Same thing I went to the Supreme Court. The Supreme Court said they gave a very bad argument. And it's very important to understand the argument why it is bad. They said that the section says if it is allowed as deduction. Allowed as deduction will happen by way of an assessment. They forgot self-assessment is also something. They say assessment, there will be an order. So step by step. A liability will happen. Assessment, there will be an order. And order, word order covers order passed under old Act new Act. I'm just keeping it short and simple. It's not that straightforward. They somehow refer to General Clauses Act. Section 24 of General Clauses Act to say order includes order passed under a repealed law, something like that. If a law is repealed, then an order passed thereunder will be valid. There is some provision in General Law. Then they refer to that order is also valid under this law. So therefore, because now also law says any notification, circular, order, etc. passed under repealed law will be valid under new law. So they said no, this order is valid under new law. Therefore, it's a assessment as if it is given reduction under this law. Why this is bad is because in another judgment of the very same Supreme Court, there is only one Supreme Court. Another judgment they say this word order in the General Clause Act section 64, and again these are income tax judgments only. The word order in the General Clause Act section 24, it does not cover assessment order kind of an order. It covers circular, notification, order, bylaws, this thing. In that category, word order can only be read as an order of a legislative body, not an executive who is assessing officer. So therefore, that argument on which the whole judgment, stands, is negated by a 3-judge bench Supreme Court later in the case. Okay, so therefore that order, that argument vanishes. Therefore, that Supreme Court judgment does not have legs to stand today. Even though that's against SSC, we don't know because of that judgment. That has been watered down. Now, what stands today? This lacuna remains somehow brought to the notice of the lawmakers. Now, they have tried to plug it to see what is the right. So, we have not been showing you slides because it's very boring to keep looking at them. I just prefer more position. Font may be small for you, but I'll just read it out to you very bit. Section 536 Section 536 of the new law is dealing with repeals and savings. The repeals and savings clause is meant to provide a bridge to connect the old and the new law to prevent any kind of inconsistency, leakages or disconnects. But the bridge, if it is incomplete, will also then therefore leave a room for leakages. So the bridge was, earlier law said, till before this 2026 Finance recent budget amendments, before this the law said, if you have claimed a deduction which was subject to meeting certain conditions, you claim some deduction subject to meeting certain conditions under the old law, and you fail to meet those conditions later on, that will be taxable law. Because old law would have said if you fail to meet conditions you will be taxable. The new law said if you claim deduction of this act and you fail to meet conditions, it will be taxable. Again, bridge was required for this. They had a bridge to say if you claim deduction subject to meeting conditions and conditions you have to fulfill in this when 2025 has started, and you fail to meet those conditions, it will become income when you fail to meet those conditions. Okay. Now, this was insufficient to capture the bad debt kind of situation which we just did. And it's not only bad debt. The same problem which I highlighted for bad debt will also arise in section 41 on taxability. Also, this is the same thing. 43B, 40A1A. Every year we will have to dissonance, impulse, allowability, and other. This problem existed. Now what they are saying is, I'll read it out and it will make sense then only. Where any sum has been allowed as a deduction, where any sum has been allowed as a deduction or has not been included in the income of any person, either on account of fulfillment of certain conditions or for any other reason. For any tax year beginning before 1st April 26 and such sum was required to be included in the income of the subsequent year, then it shall be so included, to make it simple. If a deduction has been allowed and that sum which has been allowed was to be included later, then that will be included. Now the taxer, I don't know, I can understand they had an anxiety to have as less words as possible, but at least the words should be sufficient enough to achieve what you want to achieve. In the anxiety of reducing number of words, you should not really omit certain things which are very critical. So now what it says is, the sum which has been allowed, that sum if it has to be taxed later. But what has to be taxed later? Not that very sum. You claim a deduction of 50 lakhs of bad debts. What you will tax is not that sum. You will see what the sum which you get, which may be 10, 5, 15, anything. So what the law provides for taxability is, if you have to tax that sum which you are claimed with. But if you have to tax a different sum, then this section language is insufficient to meet that objective. Because you are not taxing the sum which you claimed with, you are taxing the sum which you are getting from your debtor now, which need not be the same sum. If 50 lakhs was your bad debt, as an example is that, you may receive 5 lakh, 10 lakh, 15 lakhs. What you receive you will tax. It's not necessarily the same sum. Therefore, the language with due respect to the law because it's still insufficient to achieve which probably they want to achieve, and was just speculating they want to achieve this thing. But then this gap still, I believe, remains.
Sir, this is 536 2x, right?
Yes. I mean, maybe I have not mentioned the subsection. So I think with that, I have come to an end of my presentation by and large. I wanted to cover this much. In this whole process, I have just kind of fast forwarded some elements, but I have covered conceptually what I wanted to cover. If there is any questions, we can kind of take up concerning whatever we have discussed, or any comments, any ideas, any other counter arguments. It's little earlier than what we had anticipated, but yes, it's not always possible to match that exact time frame. So I believe none. So I can sit back and relax. Thank you very much for being here patiently listening to me. It's wonderful experience here today. Thank you.
Thank you.
Sorry.
In a lot of places we see under the new act, because of the change in language and different interpretation is emerging, which may not be the intent, which may not be in sync with what the 61 Act says. In all these scenarios, as a taxpayer or as a taxman, can I take shelter of 61 Act to say this is what 61 Act meant, and this is what the 61 Act said, and this is what they meant under the 25 Act, and continue with the same understanding that I had under the 61 Act?
I wanted to avoid any difficult question, but this my brother doesn't give me. Tell you. So, his question, let me amplify the question once again. The language of the new law is certainly not identical. Substantially the same, but there are modifications here and there. What do we follow from these modifications? Whether I can fall back on interpretation given to the courts earlier. And the answer is both yes and no, and I will give you one example of these. Section 68 cash credit section. Section 68 cash credit section, it says there is a credit in your books of accounts. Any sum credit in the books of accounts, you offer no explanation, will offer explanation offered is not of the satisfaction of the officer. Then again what said? Officer may tax this as your income. The new law says officer shall tax this. There is a fundamental change from may to shall, and we all know by now when the law says may, it's a possibility. When the law says shall, it is closure. You have to do it. Now, if we just look at this change, it is illusionary. It is misleading change because the wording has changed, but the effect has not at all changed. You will tell me something, how it is possible that the may has been subject to shall, and the effect remains the same, and I tell you why. Because the moment you read in the entirety the section says you shall tax. Of course it says you shall tax, but when A and B are met, what is A and B? Explanation not offered, or explanation offered but not satisfactory. The moment you demonstrate explanation what is satisfactory, the next claim doesn't apply. So from may to shall, the language change has no significance at all. This is one example. Any example you will give? Where there is change in language, you will fall back on the old provisions.
Most popular one given is for section 6, where the existing section talks of period or periods, and the new section talks of only total period. So there is a school of thought to say where there is broken period for 180 days, when the new law does not make you a resident.
See, it is now I would rather say that no single formula can be said to say whether change of language is resulting to change of meaning or not. We cannot just like that say that, as a thumb rule, we cannot say, hey, ignore the change in the language, see the old act and be done with that. That thumb rule, I doubt whether that will save you. So, you have to evaluate the change in language and then see the possibility because of something. It could be that rest of the section, just I took an example of 68. If there is something else in the section which supports the same thing to continue, or there is some settled Supreme Court jurisprudence, some principle which still supports the same theory, a blanket check cannot be given, I believe, to say that it will always be driven by the old laws. That's my personal view.
Can we fall back on the old law? Repeat.
Sorry, sir?
The old law. Repeat.
We can, but I am saying with caution that you cannot just overlook the new law. You can fall back, but you have to have a basis to kind of fall back on that. It's not that you simply ignore the new law's language and then fall back. That may not suit.
So, briefly, you said it's very clear that it is taxable as a purchase, but when claiming as an expenditure, it's a personal expenditure,
Yes.
personal trade.
Yes.
To that I want to say, this trip has came because of the business what I have got, so because of the business arrangement, I got this trip. If that business arrangement gives me an option that either you can go for trip or you get a discount, then I can think about that. That I have selected for this trip and I have an option for that. But if there is no option for that, and the trip when it comes to the personal trip, when I go on where to go, I will select which place to go. It's like whatever is arrangement they have made, having not, if you accept or you don't accept, in that scenario, it should be a business expenditure.
So let us take it this way. I have not accepted to go. I have not accepted to go. But you have gone there. I will not be taxed.
Yes, you
You
will
will
tax as a purchase rate. So, but
Now take a scenario that you have been given cash. The easiest way to understand, you have been given cash. You have an option to go to pleasure trip or to go for business meeting. If you go for business meeting, it will be easier. You go pleasure trip, it will not be. So just because it has come from this route, the pleasure trip has come from the meeting target incentive, etc. That does not become allowable. That's my humble view. Maybe you want to try your, argument.
the only thing is if they have an option, they would have given some options. Saying that you can go for this, you can select for this trip, or you may get a discount. Then we had a chance, we had a choice, and I have selected for personal trip. Then then the depending point that it's a non-allowable expenditure that can stand for that. But having no option, I have to miss that or have to do with that. When I have selected that, I am offering as an income also. Then why can't I claim as an expenditure? Because this trip has came because of the business.
See, I do not want to say no because first of all, I am not your assessing officer. There is no point. Neither am I looking for this. So why should I block your thought process right here? That's one thing. Secondly, when you take arguments, okay, the most important thing is your own conviction. So if it is a faceless assessment, when there is nobody to hear you, assuming they read what you write, and if you write in a compelling manner, they can accept it. I mean, so wish you all the best. I am not convinced, but that should not stop you. Maybe tomorrow you succeed in this judgment reported, I will also cite. See, that happens. So I have at least personally seen that I have not been convinced with certain things in the beginning. But then after some time, my understanding has grown, then I have accepted those things and taken those arguments.
Sir, that car example you have given, till a car gifted basically, he met the target. So suppose in that case, he will tell, okay, I gifted him the car. Okay, not because of target, I just gifted him. That is not a capital asset.
Wonderful. If it is gift, the gift is without any quid pro quo. Then it was not an announced scheme. He did not meet the targets, but it was still given him. That gift is a separate clause is there to say cost is zero.
And that is not even a capital asset.
That is not even a capital asset.
Yeah. In that case, there is no taxability.
Your 56 to 10, why it is not capital asset, sir?
No, but in capital asset definition, it will not cover car.
Well,
No.
okay, 56 to 10 doesn't cover car.
Yeah. In that sense.
So he says, sir, you are giving me this car and don't give it under scheme, just give it. Don't give a label of my incentive, it will become 28. Without that, it will be free. Interesting. The challenge will be if the person who is giving you, if he is giving you gift, it is disallowable in his hands. So then government will also not worry, it's not taxable in your hands. You want to pay the reduction, then you have a problem.
But you will be taxable on just 56.
So is it? As a gift is flexible, but the class of assets. See, what it covers is your shares.
In that jewelry, diamond,
Car is not there.
Like Mukesh Ambani gifted 10 crore, at the time of Anand Ambani wedding to everyone, the watch, that was not taxable. Because of that personal asset, that is not capital asset, that is personal asset.
He's saying no more questions. I am okay, but he's saying no. Anyways, thank you all.
Thank you.
So I would like to thank today's speaker, C.S. Sumeet Khurana, for accepting the invitation and giving a wonderful knowledge session for all the members here today.